Hi, everyone. I'm Ivan Bayuki, and welcome back to Wall Street Silver. Our guest today is James Turk. He is the founder of Gold Money, and he also has a new book out. It's called Money and Liberty in the Pursuit of Happiness and the Theory of Natural Money. Thanks for joining us, James.
Hi, guys. It's great to be with you.
So, Mr. Turk, silver, a lot of people in Wall Street Silver, we're all happy because silver's on sale again today. It's down, so people are loading up. But you sent me this chart, obviously, the silver weekly chart going back to 1975, and walk us through it. Why should we be paying attention anymore when silver's so way down?
Silver is still in a basing pattern. The bull market hasn't begun yet. I've been following this chart since doing my newsletter back in the 1990s. And to sort of explain it, we had the move to $50 in 1980. It was unsustainable because silver was very overvalued at that price at that moment in time. We then had the distribution over the next several years. Back in the early 1990s, we based out. That's when Warren Buffett started accumulating his 130 million ounces of silver, which he eventually sold, as he said, too early in 1997. But this huge accumulation pattern was completed in 2011. That's the cup. What we've been doing since 2011 is doing the handle of the cup and handle. In normal technical analysis says the distance from the bottom of the base to the neckline, which is the red line there, should be where you should have as a price target when we finally break out and begin the bull market when silver moves over $50 a barrel. And you can see that would put silver over $500 at some point in time in the future. Can't predict the timing, but this is the road that we're moving toward, and we can expect much, much higher silver prices in the weeks and months and probably years ahead.
Yeah, it's just painful to wait for that to start. So many people are I hear it nonstop on Reddit and on Twitter. And so a lot of us are just like, all right, we're ready. Come on, we're ready. Let's get it going. But
we remember silver is money. It's not a quick get-rich scheme to make money. It is money. The way you can play it with leverage and things like that, but that entails a lot of risk. What I recommend is just continuing to accumulate it, or as like you guys like to say, just keep stacking it, so that you're prepared for the problems that we face, which is not only inflation, but I think we're on the edge of a financial crisis like 2008, which will bring a lot of the big banks to their knees, particularly over here in Europe.
Well, I think that's very true. I think a lot of people, we just had the negative 1.4% GDP number a week or two ago. The Fed just raised another half point recently. They're talking about another half point at the next meeting. The markets are way down again today. All this, the past week or two, that a lot of 900-point moves, swings going on. A lot of people are wondering if the Fed has to go back to easy money. Will that pivot back to or pausing or the pivot back to easy money? Is that the trigger that might launch gold and silver once the market realizes the tightening cycle's over?
Yeah, it could be that. It could be a collapse of some bank, some derivative position blowing up. You just don't know what the trigger is going to be. But the problem that the Federal Reserve has is the level of debt that we've got today is just unsustainable. And what you're seeing is a liquidity crisis, because even 0.5% or 1% increase in, look what it's done to the stock market. Look at what's happening to the T-bond market. The T-bond market is literally collapsing, and a lot of banks that own this long-term paper and insurance companies that own this long-term paper, the value of that is just diminishing. But look at it this way, 10-year T-notes now are yielding 3%. The inflation rate is approaching 10%. So at the end of the year, you're still losing $7 of every 100 because of that differential between what you're earning in interest income versus the inflation rate. And that interest income doesn't even consider the tax consequences that you have to pay the income tax on. So the problem that the Fed has is they can either raise interest rates to save the dollar, which is what Volcker did, or they can keep interest rates low to try to keep this bubble up in the air. But eventually that will destroy the dollar. And that's why you need physical gold, physical silver in order to get through this bubble that's going to be popping.
Yeah, save the economy or save the dollar. They can't do both. They got to pick, right?
That's exactly right. And, Volcker did the right thing. He saved the dollar, but he raised interest rates. Prime rate was 21%, government bonds were 15%. Well,
Well,
you can't do that today
Yeah, there was so
because,
much less. There was so much less debt back then. I mean,
yeah, absolutely. You know, if you raise interest rates 1% on $30 trillion, that's $300 billion a year of interest expense the government's got to pay. And the government's revenue is only 3.5 trillion. So, you know, 1% is almost like 8% of annual revenue. You raise it like to 10%, you know, that is annual revenue. That's how you get into hyperinflation, because the Federal Reserve just ends up creating more dollars to pay the interest expense, and you get into a vicious cycle.
well, I
Hopefully
think
we won't go that way.
I think the thing a lot of people don't realize is back in the 70s and early 80s when we had Paul Volcker, we didn't have all these derivatives. We have all these leveraged bets on interest rates and on bonds and everything. These guys bet on everything, right? If it moves, they bet on it.
Yeah,
And
that's exactly right.
if
But you
interest
still
rates,
have,
if we were to raise interest rates 3 or 5%, someone's on the wrong side of those trades, right? Someone's
that's
going to
right.
blow up. There's no way around it. And then we're at, I mean, they can't raise rates 10%. That's just too much of a shock to the system.
Yeah, no, they can't do it. So, you know, the outlook for the, you know, national, you know, fiat currencies is pretty bleak. And it's just a matter of time before, you know, the metals, you know, take off as people exit financial promises and own real things. I think that's actually one of the reasons why crypto is being hit here. It's trading like the stock market. You know, it's viewed as a technical thing, you know, like a tech stock, as opposed to something that's real. And it's not real because you can't hold it in your hands.
The next chart you sent me is the dollar, euro, and gold relative to crude oil.
Yeah,
explain this to us and what we should be paying attention to here.
yeah, this is important because, you know, a lot of people are saying that gold isn't doing what it's supposed to do. But if you look at it from a long-term point of view, it is doing it. It's preserving purchasing power. Obviously, you get fluctuations in the price from week to week or month to month. But from a long-term point of view, gold is preserving purchasing power. This is a base 100 analysis. In other words, in 1950, I assumed that the price of crude oil in the dollar, the euro, and a gram of gold was at 100. And you can see how badly the dollar has done because of inflation. The euro is also inflated because of inflation. But a gram of gold buys basically the same amount of crude oil today that it did 70 years ago. It is preserving purchasing power. And if you want to go to the next chart, this also works with silver. Growing up in Ohio in the 1950s, I remember my parents could drive the family car into the local gas station and fill it up with 2 silver certificates, 4 $4.50 or 8 quarters. In other words,
wow.
$2 worth of silver, and fill up the family car. Today, you can still fill up the family car with the content of 2 silver dollars, but $2 only buys, you know, a fraction of a gallon of gasoline, let alone filling up the family car. So if you put the two together, the two charts, you can see on the bottom that there are fluctuations between gold and silver prices of crude oil, and that's basically reflecting the gold-silver ratio. Because remember, every good and service, there are 4 forces at work. There's the supply and demand of the good, the crude oil, and then there's the supply and demand of the money or currency that you use to calculate prices. So you've got supply and demand of silver, supply and demand of crude oil, same thing with gold, same thing with the dollar, supply and demand of the dollar. And what's happening with the dollar is the Federal Reserve is debasing it by increasing the quantity of currency faster than new wealth is being created in the economy. And as a result, you have rising prices.
You were talking also recently about the link between monetary metals and liberty. That's a theme in your book. Can you explain what you mean by that?
Yeah. One of the things I discuss in the book is a speech by Howard Buffett, who is the father of Warren Buffett. It was given in 1947. Remember, back then, gold was illegal to own by Americans because it had been confiscated by Roosevelt in the 1930s. Just like Hitler, Lenin, and Mussolini confiscated the gold in those countries. And the reason why they did it is they wanted to get gold out of the hands of the people. Because in order to control your government, and this was a theme of the Howard Buffett speech, in order to control your government, you not only need free and fair elections, you need to use natural money. Because what the government does, if they have control of the monetary process, if they take the gold or make gold illegal to be used, they can create purchasing power out of thin air through the banking system. And that purchasing power that they create competes with the purchasing power you earn by working hard, at your job day in and day out. So purchasing power comes into existence in two ways. You either earn it or you create what I call phantom purchasing power through bank accounting. And the government uses bank accounting, this phantom purchasing power. But when that purchasing power is conveyed, whether it's conveyed by metals, like we just showed in those charts of crude oil prices, or currency, it's purchasing power. It's treated the same way. There's no differentiation between phantom purchasing power or real purchasing power until you get the financial bubble breaking and popping, like it was in 2008 or many, many other times throughout history. Then you start to focus on counterparty risk. And when you focus on counterparty risk, you're talking about these liabilities of the banking system circulating as currency, which come to be doubted because promises are broken in a financial crisis because too much debt is taken on in the system. So I think the message for this particular discussion that we're having here today is that we are on the edge of financial crisis, in my opinion. It's going to be worse than 2008 because the problems are much, much worse today. And the Fed is so far behind the curve in terms of trying to preserve, not just the Fed, I should say all central banks, trying to preserve the purchasing power of their national currency that they supposedly manage to maintain a stable purchasing power. They're just so far behind. They can't possibly catch up without some dire consequences. And what these consequences are going to be, not only will it affect the purchasing power and your wealth, but it could very well affect your liberty, your freedom, because when you have a currency collapse, you can go either the right way or you can go the wrong way when you rebuild the system.
Right.
In America, after the collapse of the Continental, the country's first currency, we went the right way. We put the monetary provisions into the Constitution, and we followed that for all the way up until the 20th century, basically 1971, when they threw away the last of those monetary provisions. And we're now incurring the same consequences that the framers of the Constitution had back in the 1780s during the War of Independence. But they went the right way. You can also go the wrong way because it's been stated and essentially established that not only in Germany, but many other countries, like Venezuela, you can go the wrong way. The government becomes more fascist, it takes greater control, and you're not allowed to dissent with the government, which is another indication of fascism. So hopefully we will go the right way when they finally recognize that this present monetary system, currency system of dollars, fiat currency is unsustainable.
Wow, that's a lot to digest.
That's really good, though.
I mean, I'm a fairly shallow thinker, and that's some deep thinking right there. So thank you very much, James. On that note, I don't know how to top that, but thank you very much for joining us. Yeah, I'll leave a link to your book in the description, and we'll talk to you again in a few months, sir.
Yeah, I'd like to do that because I think things are going to be pretty tricky as we move forward from here. And perhaps my 75 years on the earth and the volume of reading and history that I studied might be useful to some people.
Yeah, no, it is. That's why we keep inviting you back. You're a wealth of knowledge, sir. Thank you.
Thank you.